Let me be really honest with you. If you're still relying on a traditional 60-40 portfolio, the kind most large financial institutions have been selling for decades, you're using 20th century ideas in a 21st century economy. And that doesn't make it wrong. It just means the world changed faster than the advice did. People come up to me all the time and say, "Hey, Dave, I've done everything right. I've saved, I've invested, I've followed the rules," and yet they feel uneasy. Inflation is higher. Debt is everywhere. Markets are volatile, and technology is reshaping jobs and industries. And the old assumptions, steady growth, stable bonds, and predictable outcomes, are no longer reliable. 60% stocks and 40% bonds was built for a very different time. It assumed falling interest rates, which we saw for about 40 years, stable currencies, manageable government debt, bonds acting as a reliable shock absorber. But here's the reality. In the 21st century, bonds are debt instruments, and debt is a fixed promise in a world that becomes increasingly unstable. In fact, there are 5 different ways that bonds can lose money. 1, interest rate risk. When rates rise, bond prices fall. 2nd is inflation risk. Your purchasing power gets destroyed even if you get paid back. 3, credit risk. The issuer may not be as safe as advertised. Think of going from AAA rated to AA rated, or if you go from triple B, which is quality, to double B, that's junk status. The 4th is liquidity risk. You might not be able to sell when you want, because if the buyers want to buy more than the sellers want to sell, the price goes up. But man, if the sellers want to sell more than the buyers want to buy, the price goes down. 5th is currency risk, especially as the dollar weakens relative to real assets. So when people say bonds are safe, what that really means is that they used to be. 21st century investing recognizes something very important. Risk isn't eliminated, it's rather managed, diversified, and engineered. That means diversifying asset classes, diversifying strategies, and just as importantly, diversifying tax treatment. This is where the conversation around hard assets becomes critical. I get asked this all the time. "David, should I own physical metal? Paper metal like GLD or SLV, or maybe even metal miners?" The answer is they all do different jobs. Physical metal acts more like insurance. There's no counterparty risk, but it doesn't generate income. It's not liquid at the grocery store. Paper metals provide liquidity and flexibility, but they're still financial products with layers of exposure. What exposure? Well, there might be 250 to 400 claims per ounce sitting in a vault someplace. Metal miners are businesses. They have ounces in the ground at costs far below today's prices. When metal prices rise faster than the labor, the diesel, and the equipment, margins can expand dramatically, and that's what I expect. That's why I believe diversified metals and commodity sleeve can help harden your balance sheet in ways that traditional portfolios simply do not. Here's where most retirement plans quietly fall apart. People focus on how big their account is, not how much they get to keep at the end of the day. See, your 401k and your IRA, you don't own it outright. Uncle Sam is your silent partner. Roth accounts, taxed on your seed, but never on your harvest. After-tax brokerage accounts, often subject to capital gains at 0, 15, or 20%. The real pain isn't just around returns, it's about after-tax income, especially in retirement. And if you don't know it, there's 101 different ways to structure that with retirement income in a way that's going to be more efficient and effective for you. Hey, if you're within 5 to 10 years of retirement, or the first 5 to 10 years after retirement, you're in what I call the red zone. And this is where one bad market sequence can derail a lifetime of work. You need to be both offensive and defensive at a time like this. And a one-size-fits-all portfolio simply isn't enough. Anything else than a comprehensive, diversified, tax-aware strategy is only half a plan. We are living through a structural economic change, and history tells us this kind of change doesn't destroy wealth, but rather it transfers it. The people who adapt now and understand the new risks and new assets and new strategies don't get left behind, but they instead build confidence, clarity, and control, and often generate real wealth that can last a lifetime. This isn't about fear, it's about being prepared for the world as it is, not as it used to be.